Hi, good friends. Welcome to this session. So under Unit 1, we have three different aspects to look at. Okay, so we're looking at Chapter 1, Chapter 19, and then Chapter 30. So I'll split them into three different videos. This very first session, we'll be looking at Chapter 1. Why auditing? Why the need for auditing? Okay. Before we start that one, you may have heard auditing and assurance. Why the use of the language assurance? Okay. Don't get it complicated. Don't worry your head so much over some of these terms. Now, assurance, like the word sounds, to assure somebody. Okay. So assurance is still an engagement. It's like, I don't want to use the word engagement now, but normally you hear the word engagement in our auditing practice. Now, engagement is more like you engage somebody. Okay, you sign a contract, a deal. So where a company will engage a practitioner and ask the practitioner to come and look at the books, okay, to examine the books, to obtain some sufficient, appropriate evidence so that they can express an opinion over the books, over the supporting the source documents. Why? The reason is that they want to assure the users of this statement, these audited reports, or these reviewed reports, that you can place some confidence, you can place some reliance on this material, okay? So that is assurance. It helps the intended user to experience or to gain some trust, some confidence, some degree of confidence, so that they can rely on these reports and use the reports for any informed decision making. Again, you may have heard of the term attestation. What does it mean? Okay, now, attestation and audit has some similarities and some differences. The purpose of attestation may also look like an assurance, okay? You would normally think they can be used interchangeably, but there could be a slight difference, okay? Now, let me show you the differences between attestation, assurance, and auditing, okay? So, like I said, assurance work is normally provided by a certified accountant, okay, a chartered accountant. So at the end of the day, they want to substantiate the data that is presented so that I can place some reliance, you gain some confidence, okay. Attestation is also performed usually by some qualified person in the realm of accounting. We'll still say a chartered accountant, okay. But here it is performed to evaluate and review how true the data or the information is, okay, when compared to a particular stated purpose, internal control systems or internal control purposes, okay? So we evaluate, we review, and then we see how true this data is, okay? And auditing is normally performed to discover data, to discover the risks inherent in the organization, to discover or to ensure compliance issues that have not been known before the audit took place, okay? So note these terms, and then you should always be able to play around the terms, okay? But if you hear sometimes attestation engagement, assurance engagement, audit is a part of an assurance engagement. We'll look at that in the chapter on chapter 30, okay, which looks at assurance engagement and the types. At this point, I'm going to go on and share my slide on introduction to auditing. Why auditing? Okay, why auditing? So that, as I said, is from the core text, Billichamp and Taylor's book, chapter 1. All right, let's roll. Why auditing? Why auditing? Now, at the end of this, I would expect us to know the difference between ownership and control, and then the agency theory. I'll talk through the agency theory, okay? I will not dwell much on it. You might have heard of it, you know it, okay? Then we'll look at why auditing plays a key role in equalizing the information imbalance between directors and shareholders. So they try to remove that information asymmetry, so ensure that there's some balance. Understand the advantages and disadvantages of having an audit. And then we'll look at the conceptual framework of auditing theory, and then we consider the expectation gaps. Any questions you find in these areas, we should be able to answer them accurately, okay? Now, shareholders, they invest the capital into the company. They own the business. They are the real owners of the company. But, they have diverse interests. They cannot still run it. Sometimes owners run their own businesses. But here we're looking at small to medium size entities. And especially we're focusing on the bigger one, the listed companies, the bigger profit-making entities, okay? Now, the directors, the management, they would manage the organization and try to ensure that it moves in a way that would sustain the business into the unforeseeable future period. So they ensure the going concern status of the organization. Now, these shareholders who are quite distinct from the organization would want somebody to tell them that, listen, your company is being run to your expectation, or they are not being run to your expectation. Because I set up the business, or I'm not the only one. A number of us, we pool resources. We start ABC company. We give it to XYZ management to run it. And we expect them that they run it in accordance to our criteria MNO. So we want an independent expert who will come, examine the records of the organization, and tell us that, listen, XYZ are running the company in line with the MNO criteria you set for them. Okay, so they come back and tell you, okay, from what we have done, the directors have actually managed the company in a true and a fair view. We'll come to look at the term true and a fair view. These experts are the auditors. Remember, we may be talking more of financial auditors, but we're not talking of only financial auditors here. We're talking of audit as a bigger practice. We have performance auditors. We have IT auditors, okay? We have other auditors, integrated auditors, okay? So not just the financial guys. So we're looking at auditors as a bigger field of discipline, all right? Now, in the agency theory, they are simply saying that these managements are the agents. The directors are the agents. The owners, the shareholders, they are the principal. The principal is trying to seek that, are you running the company to safeguard my investment? Will I get dividends on the money I have invested in the company? What about my capital? Will it grow or it will drop over a time? So we want to see stock prices appreciating. And at the end of the day, there should be value, maintenance of value within the share prices, within the stock, within the particular company I am running. At the end of the day, I should be proud that my company is performing as per expectations, okay? Now, these agents, the directors, the management, they are interested in their benefits and their salaries, okay? They want to see bonuses at the end of the year, fat bonuses, so that they can get some holidays to enjoy, all right? And they also, at the end of the day, would want to have some share options in their company. I don't want to be running the company all alone for somebody. Will I get some share-based payments? So, IAS 19 employee benefits, where we could also look at share-based payments, give it to them, reward them so that they can also own up as if they are owners of the organization. So at the end of the day, these agents, the directors, want to see personal success of a successful business measured by share prices. So the agency theory, the number of books literature has been expanded on it in the 18th century. When you read that book, The Wealth of Nations, by that popular literature by Adam Smith, it tells us that these directors are managers of other people's money, not their own, okay? So it cannot be well expected that they can manage it the way others would want to. Sometimes people are selfish by their own selves, okay? So how do we ensure that they would run it in line with what the principals, the shareholders would always want them to? Now, if you take the text, page 3 specifically, yes, the ICAEW, they put it in a certain interesting way. They said, in principle, the agency model assumes that no agents are trustworthy. And if they can make themselves richer at the expense of the principals, they will do it. Okay, within the human heart lies that element of greed and selfishness. Now, the poor principal, so the argument goes, has no alternative but to compensate these agents very well for their endeavors so that they will not be tempted to go into business for themselves. at the expense of the principals. Okay, so the origin of auditing goes back to the time back to times scarcely less remote than that of accounting. Whenever the advance of civilization brought about the necessity of one man being entrusted to some extent with the property or resources of another, then it is the advisability of some kind of check upon the fidelity of that former person would be very prudent. So all that they are saying is, within the heart of human beings lies that element of greed. He wants to run it to satisfy himself first before thinking of you. Therefore, to keep him in check, let us build that concept of auditing to ensure that these managers, these directors are running the business in line with what the principal expects, okay? Now, take this story, the agency theory out of Bell and Gardner. They published the seminal work, Modern Cooperation and Private Property in 1932. And they stated that corporations will grow, so the financial requirements will make it increasingly difficult for individuals to maintain majority shareholdings. So the shareholdings will become divided, fragmented among a number of people who wants to invest, okay? So you take any company you can think of, HSBC, even the big brands, Amazon, name them. People have their shares within, okay? So as the shareholdings become more diverse and diffuse, the only one constant in the company is the management. Many shareholders, one management, okay? Now, companies will grow in size and in power, okay? So at the end of the day, their wealth will become broad and enhanced. But what we are asking is, would the managers run the company as if it is theirs? If not, let us get somebody, even if yes, let us get somebody who will ensure that they run it in line with what the shareholders would require, okay? Now, what is the purpose of an audit? Over the past, you may have heard of scandals, Enron, WorldCom, Barings Bank, name them. So people may have lost interest within the financials of the companies. Therefore, the import of an audit, the objective is that somebody should come review the books so that they can invest some level of confidence in the users who use these financial statements. Of course, it is an opinion that these auditors will express on the financial statements to tell you that the financial statements have been prepared in all material respects in accordance with IFRS, with country-specific gaps, okay, or any applicable financial reporting framework. Now, in most cases, in most general purposes, the intent of an audit is to ensure that it gives a true and fair view in line with this particular reporting framework, okay? So look at ISA 200 and gives you the overall objective of an audit. Now, stewardship and accountability is what has called for this audit. Directors are agents. They are the agents of the principal, the shareholders. Their duty is that they should become faithful stewards to the principals, okay? So safeguard the assets, the resources, the investments of the principals and account to them. Tell them that this is what I have used your resources. These are the dividends which accrue onto you, okay? So stewardship and accountability, because they are sometimes in balance. Directors have a kind of information which shareholders don't have. There is always the need for an audit to ensure that there is information symmetry, balance between the two of them so that they can all have the same piece of information, and other potential investors or users of these reports can place reliance, assure them. It's an assurance engagement to assure them, to build some confidence in it. Why do we need audits? Why do we need audits? So like I said, directors are motivated to show good results. Pay them. Okay, like I read from the ICAEW statement, which they issued in 2005. Induce them, pay them, give them good salaries, share-based options, year-end bonuses, so that they can work well to make sure this company survives into the foreseeable future period. So shareholders want to see this reality happening. But of course, friends, it is sometimes not practical for shareholders to check this account. That's why they will bring in an auditor to check the books, look at where there are weaknesses, recommend feasible corrective actions to solve these issues, and ensure that the system is robust enough to prevent any leakages or any wastages, any unfair reporting within the system. Okay. Now, the directors, remember, it is not the duty of an auditor to prepare the financial statements. Usually, we may be thinking that, so we'll come to that in the expectation gap. We may be thinking that the financial statement needs to be prepared by the auditors. No, it is the duty of the directors. They must act in good faith, okay, likely to promote the success of the business for the benefit of all its constituents, all its stakeholders, okay? So what do they have to do? In this way, the likely consequences of any long-term decisions falls upon them, and they have to take said decisions. They must run the business in the interest of all stakeholders, talk of employees, suppliers, customers, lenders, the banks. They have to run it, even the community. Okay, what impact does the operations of the company have on the community? So we're talking of sustainable development, sustainability. These all fall within the duties or the realm of the directors, and to ensure that the company maintains a reputation for higher standards and business conduct, and they must act fairly when dealing with all members of their community, all members of all stakeholders that deal with the company. Okay, and this you can find it enshrined in section 172 of the Companies Act 2008 UK. All right. Now, reporting, like I said, again, if you look at companies regulations, the miscellaneous reporting regulations 2018, it sets out the requirement for strategic report, which must be included in the financial statement of listed companies. So today, you don't just find a statement of profit and loss and statement of financial position and cash flows. They want you to include a strategic report. Within this strategic report, section 172 of the Companies Code gives specific requirements of what you should put in there. So today we see CEO statements, CSR statements being plugged in as part of the requirement, okay? So they contain this, they normally sync, I think, yeah, let me use the word, they synchronize with the revised UK Corporate Governance Code, the 2018 code. Currently, that's what we have. Hopefully they will revise it. It's not a surprise. It has been revised over the years, okay? Now, the requirement relates directly to corporate culture and directs directors' attention away from the previous imperative of maximizing profits, just thinking of wealth maximization. No. Now, they want you to consider other factors, impact of your operations on stakeholders, on other, consider the non-financial, other qualitative factors that you need to include in a strategic report, okay? So it becomes voluminous. It makes the report voluminous, but it's necessary, at least, to ensure that companies are not just using resources from the organization and from the community without giving back to the community, okay? There are additional laws about directors. Section 173 talks of a director must exercise independent judgment. 174 says that the director must have skill and diligence and exercise reasonable care. You don't go and hire any director at all, comes to sit in the office without doing anything. He must be able to understand what is happening. Okay, so now directors must have the core technical know-how to supervise their subordinates. Again, a director must avoid any situation of conflict of interest and ensure that they promote the interest of the company first. Okay, so that's interesting as we see within the Companies Code. Again, the director must not accept any benefit from a third party. It could be some gift, okay, some bribery. We don't want you to do that. It could influence your judgment and impair their judgment. So if a director of a company is in any way directly or indirectly interested in a proposed transaction or arrangement within the company, he must declare it, the extent, the level, the scope of interest that he has to the other directors, okay? Don't conceal it, and it's expected that they disclose this, and it is kept on file. Financial information is what we'll be looking at more when we talk of auditing. So for this level, I want to just show to you that, to highlight the value of any financial information. When the auditors review this, they want to ensure that we can place reliance on these. All stakeholders can place reliance on these financial statements, okay? So not just to the investors or regulators, we're also looking at employees, suppliers, the HMRC tax authorities, the banks, the customers. we want to place reliance on whatever information these companies provide to us. There is a fiduciary relationship. I've cited this in the agency theory, okay, where directors must ensure that the resources of the shareholders are put to a proper use, okay, preserve these assets, safeguard these assets to ensure that the shareholders' resources, their investments increase in value. They should get some good dividends as a result of what they've invested in the company, okay? Still links to the agency theory. So a fiduciary relationship would always exist between the parties, usually the directors, and then we expect them to be transparent and accountable in their reporting. And this deals with cash, the finances, okay, the quantitatives, the numbers. What does the auditor do to gather evidence? Prove to us that the profits and losses have been properly stated. The income and expenses represented or presented on the books is true to some great extent, okay? The assets and liabilities are correctly stated, okay? Have they used the correct accounting entries? That's what auditors do, basically, okay? They look at all underlying source documents that finally results in the preparation of the accounts. So to do this, they must review the control systems, the accounting records. They need to ask for explanation. They need to consult third parties, go to the bank, write an independent confirmation letter to the bankers of the company, ask them whether this money that the company is reporting is actually true. Okay, talk to the debtors outside, talk to the creditors outside, let them check and see whether what the company has reported is true. Okay, I'll give you an example of a scandal that occurred. Now, during the course of the work, they would discover weaknesses in financial reporting, financial systems. They would check compliance with applicable laws and accounting standards. But remember, they are not fraud examiners. But in the course of their duty as auditors, if they find out any red flags, any signs that shows that there could be possible fraud, they need to flag it out. But errors, they must always flag it out in the area of their work. Audits has advantages, okay? The banks who give finances to the companies to run, we want to see these audited reports so that they can place reliance on this. Look at the ratios which have been constructed or which have been produced to be sure that the company is credit-worthy, okay? Creditors want to rely on these audited reports so that they can take decisions as to whether they should increase their terms of credit or just curtail it, okay? It also reinforces financial discipline within the organizations, and it helps the company to establish some trust with other stakeholders. There may be some shareholders who are not involved in the business, and their interest will be protected by the audit. So the audit will protect their interest, okay? And it provides reassurance for the directors that the figures they are reporting are good. HMRC, the tax authorities, will need these audited reports to compute or to settle their tax and VAT liabilities, okay, which the company must pay to these regulatory authorities. But there are some seemingly limitations or disadvantages of an audit. Usually, audits are conducted for compliance and does not assist the management in running. It is also more of historical. So we cannot forecast what is going to happen in the future. Sometimes it's limited to only the numbers. We're talking of financial audit and not the qualitatives. It's difficult to go and review the quantum of carbon monoxide that has been emitted into the system. It's quite difficult, okay? So sometimes it's all about money and figures and numbers, and we forget the qualitative or the non-financial ones. The cost of audit represents a non-productive expense, and the money could be used elsewhere. You pay for the audit for historical activities which has occurred. You don't get the money back. Sometimes the audit fees and the audit expenses are just ridiculous. So like I said, banks, other lenders, suppliers can make their own conditions without relying on these reports. Sometimes they want you to give us a collateral, bring a personal guarantee. They want to monitor the performance of your bank account, not your audited report, okay? Suppliers will deal on a pro forma basis, cash before supply. Give us the cash. Don't need your reports, okay? Until some trust has been established between them. Like I said, this is historical. We don't look at forward-looking items. So it is always looking at things which have occurred in the past. Other benefits of financial audit, which we'll be looking at more. We have operational audit, are procedures being followed? Compliance audit, are we complying with what the regulator has stated? Okay, internal auditor can do this operational and then compliance. And then when you come to ISA, International Standards and Auditing 610, you will see that the external auditor will place reliance on the work of the internal auditor. There are some criteria which they need to look at. I'll look at that in the next video. True and fair view does not mean that the books are all correct, totally accurate, or free from errors. No, we deal with sampling in audit. We deal with materiality thresholds, okay? So it means that it is a reasonably fair representation of the company's performance, their assets, their revenue, their liabilities, and the balance sheet. It doesn't mean that we tested everything. We can't do that. We cannot do that. Look at Tesco. How many transactions do they run a day in one of their branches? Thousands of transactions. In a year, they have millions of transactions. Can you look at all the millions of transactions? You can't do that. We deal with some samples, okay? So true and fair view doesn't mean everything is right. There are some rights, duties, and responsibilities of auditors I want you to look at. The auditor has the right for any information they seek for explanations you need to give to them. They have the right to access any company records, to receive any notices, attend to any meetings, and speak at the meetings. In case of removal, yes, they have the right that I want to remove myself, okay? And they also have to make representations to stay. I'm doing a good job. I think I can still stay. And they, as I said, attend these meetings. Their duties is to the shareholders, not actually to the directors, because they are working on behalf of the shareholders. Remember, when we talked of stewardship and accountability, it is the auditor that will tell the shareholders, the principal, that the agents are working in line with what you have stipulated or what you have agreed them. Okay. Their responsibilities could be to leave or to resign if they think they are not eligible. All right. So let's know these ones once we wrap up. There's been some theory and then postulates and concepts. When I talk of postulates, I'm talking of assumptions, okay? I'm looking at the time and I want to give you a hint on where to read these theories. Okay, so when you take the core text, I would advise you to look at pages 13 and 14, okay? We have the theory of rational expectation. It used to be called the theory of inspired confidence, and it was proposed in 1932 by Professor Theodor Limberg, okay? Limberg is now, this is the concept of expectation gap. He says that the work carried out by the auditor should be governed by rational expectations of those who use their reports. So auditors, don't disappoint our expectations. We expect you to find ABC. Are you doing ABC, okay? So furthermore, auditors should not seek to raise those expectations by any work than what they can do justifiably. Don't mislead the public by trying to think that you can do extra and become a fraud examiner. No, that's not your realm. That's not your field. Do what you have been mandated to do. That is where the expectation gap comes in, where the public expects you to do A, but they find out that you've done B minus. So they think you're not doing the right thing, okay? Then we have the philosophy of auditing, okay? And that was proposed in the year 1961 by R.K. Morse and H.A. Sharaf in the US. Now, they stated that auditing should be based on scientific logic, where the auditing process should be a rational, sequential, logical process of examination, observation, evaluation of evidence. They gave 8 assumptions, okay? But listen, we cannot do auditing based on scientific. Sometimes you have to be unscientific. Now, there are 8 assumptions. You'll find them on page 15. It says financial statements and financial data are verifiable. That's the first assumption. There's no necessary conflict of interest between the auditor and the management, which cannot be true, okay? Financial statements and other information submitted for verification are free from collusive or unusual irregularities. It's not true. Sometimes people collude and cook the books for you, okay? Existence of a satisfactory system of internal control eliminates the probability of irregularities. Is not true. Sometimes you can see irregularities in the internal control. Consistent applications of the gaps, generally accepted accounting principles, result in a fair presentation of the financial position and results of operation. It's not true. Sometimes you see the gaps being revised. So you have to go back and restate the values, okay? In the absence of clear evidence to the contrary, what has been held true in the past for the enterprise will still remain true in the future. That in the absence of anything, so you see auditors will write Sally, same as last year. They think what has happened in the past is the same in the future. No, that's the assumptions they held. They also thought that when examining financial data for the purpose of expressing an opinion thereon, the auditor acts exclusively in the capacity of an auditor. No. Sometimes auditors move outside their shoes as auditors and work as if they are the directors or the shareholders, okay? And then the professional status of the independent auditor imposes commensurate professional obligation. To a great extent, I agree with that, but there can be some weaknesses, okay? Now, finally, Flint, okay? In 1988, Professor David Flint also tried to augment the theory or the philosophy of auditing by Morse and Sharaf, and he also postulated 7 assumptions on the fundamental idea that auditing has a social benefit and it's not simply a technical exercise for the purposes of regulation. All right, I'm wrapping up. Like I said, ACCA cited this. They gave this definition about expectation gap, what the public expects from the auditing profession and what the auditing profession actually does. The difference between them, okay? Usually, you might think that the public perception is that the auditors prepare the financial statements, they check every entry, they find fraud, they take responsibility for the financial statement, they ensure the financial statements are accurate and give early warnings of business failures. That is not what auditors do. That's not what auditors do, okay? They deal with sampling, they test some and leave some, okay? So it is not actually true that these are the things, but this is what public always say. So when they hear a company collapsing, they'll say, but where are the auditors? Where were the auditors? Was it not audited by a particular company? Okay, I don't want to mention any name. So these successive attempts to redefine the expectation gap has resulted into a split, okay? Reasonable gap, where the gap between the responsibilities expected by the society from auditors to meet and what actually has been reasonably expected of them. Reasonable expectation gap, okay? And then we have the performance gap, where the society is expecting them to perform a certain item and what actually these guys delivered or couldn't deliver. So talking of performance-based output-input relationship there, okay. I'm wrapping up. I think I've gone past my time, but I'm wrapping up. So audit relevance. Audit is relevant today, very relevant. It protects the interests of investors to ensure that the information they have is timely, accurate, and reliable, okay? Corporate governance practices in our times today have allowed, has allowed auditors to ensure increased accountability and disclosure, also to help move out, remove any conflicts, okay, between the rules-based approach. In the UK, we deal with more of principle-based, and then the US deals with more of a rules-based, okay? So you read of Sarbanes-Oxley, okay? And I would expect you, if you to make time and read about this particular item in the core text chapter 1, okay? So you see the Sarbanes-Oxley directives, which conflicts with the principles-based UK system, okay? The need for auditors to use IT, technology, and develop new approaches to the audit at large is also giving the audit profession some relevance, okay? So we try to keep people on their toes, use the most updated system to audit and ensure that we provide value to everyone. Today, in our world, the auditing profession is expanding. It's expanding. Not just the numbers are we auditing, we are looking at providing some strong audit function to almost everybody who plays a role in the performance and survival of the company. Auditors are now moving into the realm of non-financial audits. Even the financial auditors are doing that. And it has been annexed by the Big Four, interestingly. They are still expanding into this area of sustainability audits or sustainable development audits. At the end of the day, all these firms that are doing is that they want to reduce the corporate failures which has occurred in the past, okay, to ensure that management can do enough, build strong internal control systems to avoid or prevent the fraudulent activities that occurs in businesses, okay? And also to promote this agency theory and make sure that they provide value to these shareholders. There are problems we face with audit. It's difficult auditing non-qualitative, non-quantitative, okay, or auditing qualitative information. It's quite difficult nowadays because we don't have the standards which we would adhere to use it. But good enough now, the Value Reporting Foundation merging with the IFRS. Value Reporting Foundation used to be with the International Integrated Reporting Council, with the Sustainability Accounting Standards Board merging to form a foundation, now merging with the IFRS to bring quality standards, which will help people to audit, okay? There's growth of internet-based online, so it has challenged conventional audit approaches. Firms are also increasingly required to take different types of assurance engagements, okay? Sometimes you see conflicts of interest occurring in the workplaces. They prepare the accounts and they still audit it. It's not the best, okay? Now, like I said, the Big Four, they've actually harnessed the audit profession. They've dominated it. They are doing both financial and non-financial. And that's the issue which is happening, okay? I end here, finally, with the audit process. One key to understanding the audit process, there are 6 levels. If any of these questions ends with a yes, if it flows with a yes consistently throughout, then the financial statement provides a true and fair view. If no, you have to do further testing, or it will end up showing that the financial statements are fraudulent, okay? I would expect you to study this audit process. We'll come back to it again, okay? But look at the 6 levels. If it flows consistently with a yes, then the financial statement will offer a true and fair view. If no, at any point, do further testing, do further reviews, okay? Otherwise, it will end up with the financial statement being representing, not giving a true and fair view, okay? There are 2 case studies on pages 19 and 20 of the current text. Please take a look at them. On the ACCA text, look at chapter 1, Introduction to Assurance, and there are some test your understanding questions on the ACCA. Use them as well, okay? All right. So friends, we have gone beyond, but we have no option because the why of auditing is quite broad. I have not even touched some of the scandals which occurred. Why auditing is taking place, okay? Take a look at the real world auditing, the case of Patisserie Valerie, where auditors did not play their role well, Grant Thornton. And this is a very recent case which occurred in 2018. KPMG had to go and do a forensic investigation after the company collapsed. And they realized that the former auditors, Grant Thornton, didn't do a good job, okay? They were dismissed. But not only were they dismissed, they were also fined. Just last year, 2021, they were fined $2.34 million for the serious lapses in professional judgments, failures to exercise professional skepticism, to failure to obtain sufficient appropriate audit evidence and prepare sufficient audit documentation. Okay, so that's what happened. And they paid heavily because these guys inflated their cash by 54 million. It wasn't the best. They have inflated their assets by 23 million pounds, okay? Receivables overstated by 17 million, payables understated. So they look too good. And auditors, when they did this, they did not do a good job. And this is what happened, okay? So look at it. The word of auditing is quite interesting. Look at the Royal Mail case where Lord Kilsant, okay, tried to falsify source documentations together with accountants, and they were fined. Actually, I think the other guys were set free, but this CFO or CEO, the director, actually ended up being jailed for 12 months. I think that's too lenient after all that he's done, falsifying and then deceiving the directors all around. All right, friends, it's quite interesting. Practice more, listen to the stories, read them, okay, and you will be fine. I'll see you in the next session. Bye for now.